Okay, we're going to finish up chapter 19 today so that we got a lot to cover. So let's start off with exercise number 1 on page 52. All right, in this one, Bailey Company has had a defined benefit pension plan for several years. At the end of 2013, Bailey's actuary provided the following information regarding the 2013 plan. It gives you the service cost was $115,000. The expected return on the plan assets was $114,000. They had an amortization of a net loss of $2,000. Interest cost on the projected benefit obligation of $16,000, and then a amortization of a prior service cost of $4,000. They decide to fund an amount equal to the pension expense. So each time, and this one has all 6 of the possible, or all 5 of the possible numbers that we could have in calculating a pension expense. So we're going to start with service cost. To that, we'll add the interest. So like I've said last Wednesday when I introduced this, the projected benefit obligation is the present value of all the future retirement benefit payments that you're going to be giving the employees that are eligible for this particular pension plan. All right? So in order to get from where we are today to the actual payments, you need to accrue interest on that in order to, just like we did with bonds, on a discount with a bond payable, is that we eventually will get to the face value, the dollars that you will in turn write a check for. All right, and this is how we do it, is the interest cost. From that, we get to deduct the expected return on plan assets. So you're going to be contributing cash on an annual basis into this separate fund, managed by a separate entity, all right, the pension plan administrators. And they're going to make as much money as they can while they've got entrusted with the cash that you give them. And then we've got the amortization of prior service cost, and the amortization of the net loss. All right, so for 2013, we have a service cost of $115,000. The problem gives us $16,000 of interest. It is also given that $14,000 is the expected return on our plan assets, $4,000 of amortization from the prior service cost, and $2,000 of the net loss. So that's a total of $123,000. So on December 31st, 2013, we would debit pension plan, pension expense, excuse me, and credit cash by that amount. Okay? All right, let's do number 4 and show you what happens if we don't pay 100% of the funding that's required in a given year. So on the next page, exercise number 4. Three, is it? Yeah, 53. On this one, Verna Company has a defined benefit pension plan for several years. At the end of 2003, they'd accumulated the following information. They gave you service cost of $127, projected benefit obligation. So here it's giving us what the total projected benefit obligation is, as well as what the discount rate is for calculating the interest cost. And then it tells us what the plan asset balance was, as well as the expected long-term rate of return on those assets. And then there's no other components. And then lastly, it tells us how much cash they're willing to contribute to that plan for 2013. All right? So we don't have any of this amortization here for this particular one. So on this one, $127,000 is the service cost. It tells us, and we'll just call this A, it tells us that we had $634,000 as a projected benefit obligation with a 9% discount rate. That's a total of $57,060. So we're going to add $57,060 as our interest cost. And then the plan had assets at the beginning of the year of $589,000. And we expect to return 9% on that. That's $53,010. So we get to deduct $53,010 for a total of $131.50. So that's a debit of $131.50. The credit is given to us in the problem at only $128,000. So we have a difference of $3,050. And that goes as a credit because we're underfunding. And we can see we've been doing that all along. We have a liability, an obligation of $634,000, but we have built up only enough plan assets for $589,000. So we've been underfunding this for years now. So that's going to go to accrued / prepaid pension cost. is the entry for that. They give it to us in the problem. They tell us at the very last sentence, Werner contributed $128,000 to the pension plan at the end of 2013. So they let us know how much that cash was going to be. Yes?
Had they ended up putting $140,000?
Then at that point, we would have debited this accrued prepaid pension plan and started whittling away on it. We know that it has a credit balance because of the difference between the obligation and the assets.
So would the total 141 go to the pension expense, or would it be whatever the excess was?
The 140, if we had, you mean if we had a 141 expense or a 141 in cash?
If they would have given us 140 in cash.
140 in cash, yes. That would be the debit to cash. The expense would still be the same.
Okay.
But what's going to happen is that we'll be building up the plan assets to kind of start narrowing down this gap, which is going to then increase the return on assets for future years. And so our expense in future years will be lower than it would have been. All right? Everybody good with that? Okay. Let's do this for multiple years. Exercise number 7 at the bottom of the same page. And I'm going to have to rearrange my board here. I didn't leave enough room. Yeah, there's no way. Oh, actually, yeah, I can. I'm going to abbreviate this to PBO, and that way I can get 2013 and 14 in here. That way I don't have to write the whole thing. Okay. On this one, it gives us a table for Carlisle Company that is adopting, well, that had adopted in the prior year a defined benefit plan. They funded the entire amount in 2012, and then it gives us the actuarial data for 2013 and 14. It tells us what the service cost each year is, what the total projected benefit obligation at the beginning of each year is, as well as what kind of plan assets. And you can see at the beginning of 2013, they are both equal to $180,000. So they funded 100% of their expense for the prior year. And then it also tells us how much they're going to be contributing for the current years. And then there is a difference between the discount rate that we use to calculate the interest cost and the expected return on plan, as well as an actual return on plan assets. So the service cost in both of these years is $200,000 for 2013 and $215,000 for 2014. The interest cost for 2013 is the $180,000 times 9%, or $16,200. For 2014, and this is also given to us, $396,200 is the planned benefit obligation, the projected benefit obligation, times the 9%, for a total of $35,658. The return was $180,000 for 2000 at the end of 2012, the beginning of 2013, and we're only expecting a 9% return on plan assets. So that's $14,400. And then our plan grows to 406,400. God bless you, times 8%, for 32,512. Add all that up for 2013, we get a pension expense of 201,800, and for 14, 218,146. So 2013, December 31, we're going to debit pension expense by the 201,800. It gives us in the problem that we're going to fund 212,000. So we're overfunding the plan starting in the second year of its existence. So now we've got this accrued prepaid pension cost as a debit for 10,200. For 14, we have the same basic entry. Pension expense of now 218,146. We've agreed to fund 220 for a difference of 1,854 that goes to accrued prepaid. All right, so those are the journal entries, whether you're over or under funding the pension expense. Okay? So the service cost is the current year expectation as to how much the projected benefit obligation is going to increase based upon everyone working for us in the current year. The interest cost is getting that present value up to current value over time. And then the return on plan assets, we get to offset the expense based upon how well our plan administrators do with managing the portfolios that they have under investment. All right? So we talked about what service the gains and losses on the projected benefit obligation is. So let's talk about what the corridor calculation is on that amortization of that gain and loss. So that's exercise number 11 and 12. We'll do 11 first. At the bottom of page 54. Left that up there. On this one, Lee Company has a defined benefit pension plan. During 2012, for the first time, they experienced a difference between the expected and actual projected benefit obligation. At the beginning of 2003, their actuary accumulated the following information related to the pension plan. So they have calculated a net loss of $44,000. And that comes from what they projected the benefit obligation to be of $228,000. That's the actual now. We have plan assets built up of $260,000. In the process of computing the net gain or loss to include its pension expense for 2013, they have determined that the average remaining service life of its employees is 9 years. All right? And so the way the corridor approach it works, well, let's just do it. We have a loss at January 1, 2013 of $44,000. From that, we get to deduct what is known as a corridor. The corridor is the larger of the projected benefit obligation or the assets times 10%. So we have $228,000 in projected benefit obligations, but we have $260,000 in plan assets. So the larger in this case is the plan assets. We have been overfunding, so we get to deduct from this $26,000. That leaves us an excess loss over the corridor of $18,000. Divide that by the average service life of the remaining employees. Which the problem gives us at 9 years, and we have a $2,000 loss.
How about the
Corridor.
Have to top 10% assets?
10% is what we're going to multiply that by. And that's just codified in US GAAP. All right? We have to amortize over the average service life the excess above 10% of the larger of either the obligation or the assets. So, in the case of a loss. All right? Let's do the very next one on page 55. Hudson Company's actuary has provided the following information. It has the fair value of plan assets at $350,000. They have an actual projected benefit obligation of $360,000, where they had expected a projected benefit obligation of $424,000. It also, once again, gives you the average remaining service life of the employees. In this case, it's 10 years. So we have a $350,000 for plan assets and $360,000 in projected benefits, $350,000. So we're underfunded by $10,000. In this case, our loss is $64,000. That's the difference between the expected benefit obligation of $424 and $360. So this is actual. whereas 424 was what we expected. The difference between those two is the 64,000. If we take 10% of the larger of those two numbers, the projected benefit obligation of the assets, we get 36,000 as our corridor. The excess gain now, because this is now a gain, because our actual is far less than what we expected. Our gain is 28,000. Average service life of the remaining employees is 10 years. 2,800 is the net gain. And we would then deduct that from our list of numbers to calculate the current year's pension expense. All right? Losses increase pension expense, whereas gains will decrease them. All right? And I can only hope that you never, ever, ever see a CPA question asking you to calculate this. Yes.
Where was the corridor with 36,000?
That's the larger, 10% of the larger of either the projected benefit, the actual projected benefit obligation, or the plan assets. The first example I did, the assets were larger. In this one, the liability is larger. The obligation is larger. So it's 10% of whichever is larger. You have to amortize the excess over that. And that's just the way the FASB and apparently a drunken stupor came up with this. I can't explain it. I'm sure they had some sort of logical explanation, but I don't know what that is. Okay? All right. So in both of these cases, the problem gave us what the average remaining service life is. So let me spend a couple of seconds before I start showing you how to solve all this using an Excel template to explain to you how you would calculate in actuality what the average service life is. So exercise number 13 and 14 on the same page. So average service life, average remaining service life can either be computed using straight line or what they call years of future service. So the straight line, it says at the beginning of 2013, Brent Company amended its defined benefit pension plan. The amendment entitled active participating employees to receive increased future benefits based on their prior service. The actuary determined that the prior service cost for the amendment amounts to $330,000, and then it gives you there are 5 employees. Employee A through E. Employee A is going to retire in 1 year, B in 2, 3, 4, and 5 years' time for E. Okay? So under straight line, you just total all this up, divide it by the number of employees, which is 5, and you get 3 years. So under straight line, you would amortize that prior service cost of $333,000. Where do I want to put that? Way over here. over 3 years. That's the average remaining life of your remaining employees. All right, so what about years of future service? Here's the 5 years that we have until we expect everyone to retire. In 2013, all 5 employees are going to work. 2014, we're going to lose A, leaving us with 4. Then we're going to lose B, down to 3. And so forth and so on. So the method for the years of future service amortization is just doing fractions. 5/15, 4/15, 3/15, 2/15, and 1/15. So 1/3 of this 333,000 is this same 110,000. Is your amortization of prior service costs. 4/15 would be 88,000. 66,000. 44,000. And lastly, 22,000. And that's how you would amortize the 330,000 prior service costs. It's similar to some of the year's digits. I mean, the closest thing to it. Yes, sir. By the 333,000 that we straight lined in the first example. Yes. Okay? So now I want to show you how to solve this using an Excel template. The fraction, in 2013, I took the 5/15 fraction, which is essentially 1/3, and I multiplied it by the 330,000 prior service costs. And then I did 4/15, 3/15, 2/15, and 1/15. Mm-hmm. Okay, we're going to do problem number 1 on page 56. So problem number 1 on page 56. So here is a typical pension expense worksheet. What it has is it has a section here by which you can track the obligation, the projected benefit obligation. And then the associated cost of either the current interest cost or the current year service cost associated with that obligation. Because the service cost is just increasing the obligation each year. And then you're going to decrease it by the benefits that you pay out. Because as you pay your retirees, that obligation goes down. Then you've got plan assets. You've got the beginning plan assets, and that's going to generate what the expected return is throughout the year. That's going to lower your pension expense. And then you're going to have a section here where you can put in actual returns. how much cash do you give into the plan for the current year, and then once again subtract out how much benefit you've paid. And then there's a section here for the prior service cost as well as net gains or losses. And then down here at the very bottom, let me freeze this. Down here at the very bottom, you've got your journal entry. So you're going to be debiting pension expense and crediting contributions in cash at a minimum. And then depending upon whether you're overfunding or underfunding, you're going to be debiting this accrued or prepaid pension costs by the difference in what you should pay in, the expense, and what you actually paid in, the cash. All right? So, in this particular problem, Turner Company adopted its defined benefit pension plan on January 1, 2013. So this is the first year we've adopted this plan. When it adopted it, it awarded retroactive benefits to its employees. So that means we are going to have a prior service cost calculation that the actuaries are going to give us. These retroactive benefits resulted in a prior service cost of $980,000 and created a projected benefit obligation of the same amount on that same date, which it did not fund in advance. They decided to amortize this using the years of future service method, and then the actuary gave us the service cost for the 2013-14, what the plan assets are going to be at the beginning of each year, as well as what the rate of returns are and the discount rates. And so we're expecting to make 9% on plan assets, whereas our discount rate for purposes of calculating the interest cost is only 8%. And then it gives us what the fractions are for this prior service costs. So it's 80 over 980 for 2013 and 79 over 980 for 2014. And that's based upon the total number of employees you had, how many years are they going to work, adding all that up, and then totaling the number of employees that you have in each year, just like we did on the board on that last example. All right? And then lastly, it gives us what the contributions are for each of the 2 years. So at the beginning of 2013, we have this $980,000 projected benefit obligation because we retroactively allowed our employees to benefit from this plan. Our discount rate for purposes of interest expense calculation is 8%. So that's an interest cost of $78,400. All right? And so what we're doing here is in this column, we're keeping track of the balances of the obligation and the assets. But in this column, we're calculating the current year's increase or decrease to the pension expense. So our beginning pension expense obligation is the $980,000. We're given that the current year's service cost, once again, that's the present value of the future retirement benefits that our current employees are making. So that's a current benefit obligation, because the projected benefit obligation at the end of the year is going to be what we started with plus the interest cost during the year plus the current year's service cost minus any benefits that we pay, lowering the liability. So $1,245,400 is the ending projected benefit obligation. That in turn is going to be the beginning obligation at the beginning of 2014. All right? If we do the same discount, our pension expense for interest cost is going to be $99,623. It gives us an additional $189,000 for the current year service costs. There still is no benefits being paid, so our ending projected benefit obligation at the end of 2014 is $1,534,32. So plan assets. We didn't fund the prior service cost, so that one is 0. Our expected rate of return is 9% in both cases, but we haven't got anything to multiply that by during the first year, so that is 0. I'm just going to fill this in. This is eventually going to be that number there. So we don't have anything to deduct, minus for the first year, but we will hopefully have something to deduct for the second year. So beginning plan assets were 0. The actual return was 0. Contributions, however, were $342,000. We didn't pay any benefits, so our ending plan assets are going to be $342,000. That is going to be our contribution to cash. So that's our credit to cash. The prior service cost was given to us at $980,000. And we're going to multiply that by a fraction, which is given to us once again, but you saw how you could calculate it using the years of future service calculation of 80 divided by 980. So if we take this and multiply it by a fraction of 80 divided by 980, we get an amortization of prior service costs of $80,000. There's no net gain or loss, so that's 0. So our total pension expense is going to be the sum of this column, $345,400. We are underfunding the pension. So this is our debit to pension expense. So because we're underfunding it, we have an expense of $345,400, but we're only contributing $342,000. So this one here is also going to be a credit. So beginning plan assets are now $342,000. We have an actual return of $30,780. We're going to contribute in the second year $336,000. That's our credit to cash once again. We still have the $980,000 of prior service cost. Now our fraction is going to be 79 divided by 980. So that's multiplied by 79 divided by 980, or 79,000. Add that. There's once again 0 as far as net gain or loss. That's a $336,852 as far as our expense. So now we're only underfunding, but we're once again underfunding. So we're going to need to credit the accrued / prepaid pension costs by $852.
I have a question.
Yes, sir.
What happens I know we didn't pay any benefits with any plan assets for 14.
It rolled up to here.
No, I mean, we didn't fill it in 14.
Oh, I'm sorry, yeah, we should.
I was just wondering.
Yeah. Yeah, so there's no benefits paid. Yes.
Okay. It didn't make a difference in the total.
No, because we don't have, but you would do this year after year, so this spreadsheet would keep going
Right.
on and on and on and on.
And then why didn't we use a negative amount as in the pension expense for the actual return?
We did.
But in the,
But the return increases the plan asset balance. Because we've made money on that 342,000. So that increases the plan,
oh, okay.
right?
Yeah.
But it decreases the expense.
Right. Yeah, okay.
Questions on how to use a worksheet?
Are you going to post that example?
I can. Let me save it. Yeah, I can post that. Right? That's it. That's all I had.
So will we use this template for our homework then?